Hi, thanks for joining us. Today we're going to talk about how to invest your money wisely and the types of savings you can have and investments. So do you think you know how and where you can invest your money? Well, let's see if I've covered off all the different areas. By the end of this video, I'll give you the facts so that you can decide what's best for you and maybe your family. So I'm Julie Kranitz. I'm a certified financial planner. I have a Bachelor of Commerce from McGill, and I'm president of Wealth Maximization Group. You might have seen my intro video that talks about I was very frustrated when I realized that only 4% of people are retiring financially independent. And what that told me is the information we must being taught and dispersed is incorrect. So I was looking for better solutions. So if you want the best info on financial independence and how to achieve it and how to get ahead financially, I'd love you to subscribe and hit the bell, and then you'll be notified of all future videos. So let's get right into it. There's basically a couple kind of investments you can make. Let's say 5 of them. There's cash, bonds, stocks, real estate, and life insurance. So most of you have real estate, so we're not really going to go too deep in that right now, and life insurance is a topic that needs its own video. So we're going to focus on cash, bonds, and stocks right now. If we look at cash is basically anything that's guaranteed. We have like a money market account, a T-bill, or kind of like a 1-year GIC or a high interest bank account. Let's look at the pros and cons. The pros are that a money market account or a 1-year GIC can quote unquote never lose money. It's going to give you a low rate of return, but you know when you go back to your bank account, unless you're in Greece, basically you're going to see that amount of money in there. So the pro is that it's kind of consistent and it can't go down in value. What is the con? Well, the con is that if you're investing in cash investments in an open environment, you're going to have to pay taxes. And if you look at the taxes and inflation, if you could get, say, 2% return right now, inflation is, and here's a little side note, some people will say inflation is about 2%, but let's say inflation was correct at 2%, then your return of 2%, less than 2%, really you're not getting any money after that. And then of course, we've got to pay our tax bill. So if you're paying 2% and you're in, say, a 30% tax bracket, you're going to pay at least 2 times 3, so you're going to pay 0.6%. So you're actually losing 0.5% every time you have money in a non-registered account. So that's the pros and cons. It's great for short-term money, but longer term, when we take off inflation, we take off taxation, we're actually losing money. So let's look at our next investment opportunity. That's bonds. That's what I call one of the least understood asset classes, or the most misunderstood. But the key to understanding bonds is that bonds work opposite to interest rates. So when interest rates go up, the value of your bonds go down. When interest rates go down, the value of your bonds go up. Another way, or a more fun way to think of this, is a teeter-totter. You know, when you're a kid and things go opposite between interest rates and the value of bonds. So let's try to understand how that works. If you think when I started in the industry over 28 years ago, I started in a bank and we used to get the bonds and they had these little coupons around, and I had to sit twice a year in the summer and in December and cut out these little coupons. And what you got to remember is, even though bonds are all electronic, it's the same concept. If Magna needed money to build a machine to build car parts, and they're buying a bond for 10 years, if you need your money back in a year, you can't go back to Magna. You got to go back to the market. So they're not going to reissue your bond. The bond is there until it matures in 10 years, and it has these little coupons. So let's say I have a bond that's paying, let's say $100,000 bond at 5%. So I'm getting $5,000 of coupons off my bond, and it would be split in 2 periods, again, one in July and one at the end of the year. So if I decide to sell my bond to someone else, those coupons are still stuck on there. They can't be changed. So let's say interest rates go up to 6%. So that bond that you can buy on the market today at 6% is going to pay you $6,000, and if you buy my bond, is only going to pay you $5,000. So you're going to not be too happy with buying my bond. You're not going to want it. You'll go and buy a fresh bond on the market. But what if I say, hey, I'm going to discount my bond. I won't sell it to you for $100,000. I'll sell it to you, and it's all mathematically calculated, maybe for $95,000, and you're going to get the same equivalent 5% return till maturity if you hold it. So what happened was, again, the interest rates went up from 5 to 6, and I had to discount my bond to make it of interest. Well, the opposite is true also. If the interest rates went down from 5%, so you couldn't get $5,000, let's say you could only get 4, then if I sell you my bond for 100, I'm losing out because I can't go replace it tomorrow with another bond paying 5. So I'm going to have to bring up the price of the bond, if you will. So I might sell it to you for 105,000. So again, for bonds, you really have to worry about what interest rates are doing. And if you remember, from the 80s till now, interest rates have come down quite a bit. So again, remember, that means your bonds have gone up in value. So what used to be a safe investment in the past was, if you wanted more safety, you had more bonds because interest rates were going up. Now we see interest rates are going down a little bit. Over time, they're probably going to go up. So it's not, if interest rates go up, you could actually lose value in bonds. I don't think interest rates are jumping up, but it's something to keep in mind when you think of bonds. And then we get into stocks. Well, instead of being a loaner or a borrower, you're actually becoming a partner, and you take part in the gains and the losses of the company. So let's look at the stocks can have some preferred taxation to them. So unlike anything that you get with guarantees, you're taxed on every dollar. If you get dividends or capital gains, dividends are preferred, and capital gains you pay tax only on half. We'll get into that in more detail in another video. But bonds mostly pay interest income, so that's mostly taxable unless you have a capital gain or loss and it's in a non-registered account. So you can see how all three of those investments kind of work differently. And again, real estate and life insurance, we're not going to go into too much right now. So if this gave you some clarity about how cash, bonds, and stocks work, please leave a comment in the comment section. Tell us if you learned something or if you have something to add. That would be great. And remember, knowledge with no action is just kind of like dreaming. You're going to wake up and you're going to find out that nothing happened. So please take some action. I do like people to realize that there's no perfect investment out there. There's not one perfect food. There's not one perfect investment that does everything. So there's pros and cons, and different things are needed from different people at different times of their life. But one thing when you're looking at stocks, bonds, and cash is you really have to look at the time frame. So we're just going to move over to this graph. This shows the markets over a longer period of time, and this goes to 2017, the end, but it's very hard to see. So we're going to go to my older one that's really easy to see. So if you look at inflation is the white line here, and you can see that in the past, and I apologize, this ends in 99, but it's super easy to see, is you see inflation was here, and the T-bill or the 1-year GIC was here. But normally, inflation just covers off what the cash investments are doing. So again, if you realize that you're just covering it off, it's great if you need money in the short term, but over the long run, when you pay your taxes, you're losing money. And then we see bonds here. And remember I said in 81, interest rates were at a high, 13-15%, and interest rates have been coming down ever since. And that's when we had our bull market in the bonds. Remember the teeter-totter effect. So right now, if you think that your interest rates are going up, they're probably not going to skyrocket, but you're going to get more of just a return similar to this. And then we have, this is the blue chip stocks and the small cap stocks. So if you look at the perfect investment for you, it really depends on the time frame. If you have a short time frame and you go into the markets, you could lose money. If you are in the guarantees, you know that your value is really not going to be losing money. So most people, when they have like the Canada Pension Plan or a company pension plan, they have a balanced portfolio that is going to be anywhere from 30 to 40% in fixed income, which is cash and bonds, and then you're going to have 60 or 70% in stocks. So again, please speak to your advisor because they can help you out in terms of what exactly is best for you. But remember, we're a wealth maximization group. We help you maximize your wealth to maximize your life. Thank you.